Hi children, good morning. Today we'll deal with the adjustment entries. Now let's see what is adjustment entries. Adjustment entries are passed at the end of the year to make adjustment in accounts so that final account shows the true and fair financial performance and financial position of the business. Now let's see the first adjustment entry, that is closing stock. Closing stock is brought in the books of account to determine the correct gross profit or gross loss. And the entry of closing stock will be closing stock account debit to trading account. At the end of the year, it is transferred to the trading account. It is an asset, it will be debited, it is transferred to trading account credit side, to trading account will be credited. Narration being closing stock transferred to trading account. Next adjustment entry is outstanding expenses. Outstanding expenses are the expenses that are of the current year but have not been paid till the end of the year. So it is a liability and expenses is due. So expenses will be debited and outstanding expenses account will be credited. Since it is liability, it will be credited. Narration mean expenses due. Now let's see the other. Our next adjustment is prepaid expenses. Prepaid expenses means expenses paid in advance for the next year also, that we have to reduce from the expenses, because while preparing the final account we only consider the expenses of current year. So what will be our journal entry here? Prepaid expenses account debit to expenses account. Okay. Now next is accrued income. Accrued income means income which has been earned but not been received. Okay. So accrued income is an asset. So accrued income will be debited, and our income, when it will receive, we will credit it, because income is credited. So our entry will be accrued income account debit to income account. Okay. Now let's see the other. Next adjustment entry is unearned income. Unearned income means income received in advance. Okay, income received in advance is a liability. So unearned income will be credited, and income we have to deduct, because we will only consider the income of current year. So our income will be reduced, so income is debited. So journal entry for unearned income will be income account debit to unearned income account. Next is depreciation. Due to the use of fixed asset, value of asset decreases every year, and that value is known as depreciation. So it is also necessary to adjust the depreciation at the end of the year. So when we adjust depreciation, our entry will be depreciation account debit to fixed asset account, because depreciation is considered as charge against profit, so it will be debited, and our value of fixed assets is reduced, so fixed asset will be credited. So entry will be depreciation account debit to fixed asset account, being depreciation charge. Now let's see the next entry. Now let's see the journal entry of interest on capital. Okay. Interest on capital is an expenses to the business, so it will be debited, and this interest will be added to the capital. That means our capital is increasing, so capital will be credited. So what will be our entry? Interest on capital account debit to capital account. Okay. Being interest allowed on capital. Next is interest on drawings. Okay. Interest on drawings is an income to the business, so it will be credited and it will be added in the drawings, so drawings will be debited. Our entry will be drawings account debit to interest on drawing, being interest charge on drawing. Okay. Now let's see, this were the adjustment regarding the interest on capital, drawings, and other expenses due and received in advance. Now let's see the opening entry. And enterprises close their book of accounts at the end of each year due to accounting period concept. In this process, nominal accounts are closed by transferring them to trading account, and the balances of personal and real account are carried forward to the next year. And these balance become the opening balance of the next year. And the first entry in the journal is passed to record the closing balance of previous year, and it is called as opening entry. In opening entry, all the assets are debited and liabilities are credited. Okay. And so all assets, for example, land and building, it is an asset, it will be debited. Plant and machinery account debit, furniture and fixtures account debit, closing stock account debit, debtors account debit, bills receivable account debit, cash account debit, bank account debit. These all are assets, it will be debited, and all the liabilities will be credited. Okay, and capital will also be credited. So our opening entry will be all asset account debit to capital account to sundry liabilities. Okay, and in opening entry, if capital is not given, we have to find out the capital. And if your liability, suppose if your liability is more and asset is less, then we have to find out the goodwill. In opening entry, we have to always see that our asset must be equal to liability. So if there is any difference, it will be either capital or it will be goodwill. So you see that if capital is not given, the difference will be capital. And if capital is given and then there is difference, that difference will be goodwill. Okay, now let's see the formula of capital and goodwill. So when capital is not given, we have to find out the capital, and capital formula for capital is equal to total assets minus total liabilities. Okay. Same way, if your capital is given and even though there is a difference in asset and liability, then the difference will be considered as goodwill. Okay. And your formula for goodwill will be total liabilities minus total assets. Okay. So in this way, you have to calculate the capital or goodwill. Thank you.